There's an autumn budget coming in October, and there'll be lots of changes for those in retirement and for those saving for retirement. I'm going to outline what some of those changes might be, how they could impact you, and what you could potentially do about it. The Labour government claim that there's a £22 billion fiscal black hole that needs to be filled, but they're not willing to do it through changing taxes on what they call working people. So they don't want to increase income tax, national insurance or VAT. But unfortunately, the Labour definition of a working person is someone that has no savings, so they're likely to go after the tax status of pensions and ISAs. Labour also don't like the fact that the lifetime allowance has been removed, so there's no progressively higher taxation on large pension pots. They also aren't so keen that the maximum pension contribution has risen from £40,000 a year to £60,000 a year, and they feel that these tax breaks are too skewed towards those earning between £100,000 and £250,000 a year. There was a recent Fabian Society report that outlined some of the changes that might be made. Some of these changes might not come in the autumn budget, but given that Labour governments tend to increase taxes progressively over time, they're likely to be enacted at some point. So one area for discussion is the maximum pension tax-free cash, and currently this is £268,275 or 25% of the old lifetime allowance number of £1,073,100. So it's just a bit of a random number that will be a historical anachronism, and it's likely that this might be changed. The Fabian Society report recommends reducing the maximum tax-free cash down to £100,000. Now, it is possible that people that have larger pension pots at the moment could get some sort of protection on those existing pots, but they might then be facing restrictions on what they can put into pensions in the future. Pensions are for long-term planning, and pension tax-free cash was designed to compensate people for the long-term tie-ups of their investments and the possibility that if you pay money into a pension, you might get 20% tax relief going in, but if you have a large pot, you might end up paying 40% marginal tax coming out. To mitigate this, you can move tax-free cash from a SIPP to an ISA, providing you're over 55, and retain the tax-free status with regard to things like interest, dividends, and capital gains. However, ISAs are subject to inheritance tax. But here comes another Labour potential tax plan, which would be to make pensions subject to inheritance tax. And it does seem a bit odd that pensions are the best way of passing wealth between generations. However, if pensions were subject to inheritance tax, it could be difficult for defined benefit pensions to implement such a measure, particularly if the spouse had factored on receiving a certain pension when their partner died. So the Labour government could impose additional taxes on wealthy pensioners. For example, we used to have a super tax in the 1960s, and if you don't believe me, you can check out the Monopoly Board. There could be a supplementary tax that's put on inherited pensions or on pension income over a certain threshold. There has been talk of making pension income subject to national insurance, but that would be a bit odd because you could have someone that's retired on less than the full state pension because they haven't made enough national insurance contributions, then being charged national insurance on the very pension that they've built up because their state pension is so low. Tax relief on pension contributions is around about £66 billion a year, and yet tax revenue from pension payments is only about a third of that. And it's also a fact that over half of the taxes saved on the pension contributions are going to those paying 40% or more income tax, even though those people are about 20% of all employees. So the benefits are very skewed in our current pension system. Top rate pension tax relief could be reduced or abolished altogether. And this might make pensions more balanced between spouses, because what often happens is you have one partner with a large pension but 40% tax relief, so they carry on making contributions to that pension even though their spouse has a much smaller pension but only gets 20% tax relief, so it doesn't seem worthwhile trying to equalize that person's pension. A possible way to mitigate this is that pension top-ups are often done towards the end of the tax year, and you might want to consider bringing this forward, or at least doing the planning activity around how much money you can afford to put in your pension this tax year. There's also the possibility of ISA reform. The Labour government could rationalise the range of ISAs available, as there's quite a lot that really just confuses people. They could put more emphasis on the idea of this British ISA, where you have to invest in UK companies or in funds that have a strong UK bias. They could also limit the total amount that anyone can have in all of their ISAs, because at the moment it's completely unlimited and there are several ISA millionaires out there. Or it could reduce the annual contribution that you can make into an ISA from the current £20,000, although that amount has been frozen for several years now. So what to do about all these proposed changes? Well, anticipating a change before it is announced rarely works. Moving money around to try and anticipate things that may never happen isn't really a good idea. And you need to remember that any changes won't be effective immediately, so you should have the rest of this tax year to put some mitigation measures into place. I'm Ian Shadrack, a qualified accountant with over 30 years experience. I coach people into how they can get the most out of their finances in retirement. My top recommendation is to take stock of your finances and to come up with a wealth plan that covers the years that you're working and also your retirement years. Some people are paying large tax bills now, and they're also going to be faced with very large tax bills in retirement. And if they came up with an effective plan, they could escape the rat race and live a very enjoyable life. And I recommend that you check out this video, which will give you some ideas as to how to go about it.